going to be putting the spotlight on some of the economic data that hit home ground during the course of this week. Nikki, thanks so much for joining us this morning.
It's a pleasure.
Well, just looking back on data this week, I mean, inflation has been in full focus. We had CPI numbers out on Tuesday, better than expected at 5.8%, the second month that we've been back within a target range. But the big question marks surround sustainability of inflation actually staying within this band. What's your outlook on the CPI front?
Well, we do see it temporarily bouncing out of that target range, but that's more going to be a base effect. So that would be like December, January. So when it happens, hopefully people won't make too much of a meal of it. It's not indicative in our sense of a massive build-up of demand sort of pressure on prices of any kind. It's more the result of, if you recall way back in dismal days, November, December last year, we saw commodity prices collapse. Obviously that has now improved and it's normalized, and you have now this massive base effect coming through in November and December and January. So then it will probably pop back out of that range, but thereafter it will start to moderate again and probably quite quickly dip back into the target range of 3 to 6%. It's going to remain sticky though.
Yeah.
It's going to be a slow process down.
Especially when you've got risk factors to consider. I mean, electricity tariff hikes front of mind when it comes to inflation.
Yeah, absolutely. 35% over 3 years, 35, 35, 35. That is, I mean, I know they say they've been merciful, but it doesn't feel that way. And if it doesn't feel that way, it probably isn't that way. So the reality is this, that will have an impact. It will have a direct impact. The direct impact in the CPI is quite small, but the indirect impact is the one that the Reserve Bank would really worry about, where it raises the cost of production, and that goes forth and results in retailers passing those cost increases on to the consumer. So it's the indirect effects that are really the damaging ones. The good news there, though, or the bad news, depending on how you want to look at it, is that domestic demand is still very weak. There's no signs of any robust force coming through on the domestic demand side. You look at the credit numbers, they really look dismal, and that's putting it mildly. So quite frankly, I think retailers' pricing power is going to be quite limited, and they're going to have to take some of the pain themselves.
Another factor to consider here, Nikki, is if the rand has to depreciate, certainly over the next 6 months to a year, because that will feed into imported inflation as well. I mean, what are you anticipating in terms of rand movement and implications then for inflation in your books?
Yeah, I was listening to your bit on the market, and you know, you're saying that everybody's squaring up their positions, which is pretty normal this time of the year. I don't think that's necessarily indicative of a long-term trend. You know, we've had the same play this whole year. You know, it's been anti-dollar, it's been pro-emerging markets, pro-commodities, any kind of safe haven bet against the weaker dollar and future higher global inflation. That has sort of been the theme of investment for the year that has passed. Now, clearly, you want to sort of feel your way around and you want to square your bets, but I think that the rand's probably going to surprise on the upside for a while to come. And the reason for that simply being is that dollar weakness is not all done. I mean, the dollar took a terrible smack this year, there's no doubt about it, but we still have some way to go. And then, of course, the other thing is that we have this build up to the 2010 FIFA World Cup. And I think that will create positive sentiment, and I think that dealers will be hesitant to short the currency under this kind of environment.
And we've certainly seen over the last year how powerful sentiment is.
It's a very powerful thing, yes.
Well, let's take a look at PPI then, because at the moment there's still quite a disconnect between CPI and PPI. For how long do you see that trend intact?
Well, I think PPI is now going to start rising. PPI is, of course, far more of a raw measure of inflation. It measures it at its first point, which is the cost of production, the cost of goods leaving the factory gate. And so commodity prices there has a very big impact. And so has electricity tariffs, because it's 6.7% of your PPI index. So that's a direct hit. The electricity tariffs will have quite a big impact on PPI. And then, of course, commodity prices and the fact that that has improved and probably will hold its value going forward will start to come through more visibly on the PPI front.
Well, let's look at employment, because we've unpacked inflation here, more reflective of our growth situation, where employment numbers were also out this week, and it's looking still pretty dire at this stage, where we're still losing very many jobs. It may be basing out and it may be moderated, but still a little too much to be happy with.
Yes, and I mean, I think if you think about it, since the beginning of this year till we are now, we are at about 1 million jobs that have been lost. Of course, the big slaughter has been in the manufacturing sector. Also, your sort of retailers, they have also been retrenching people, and then finance and real estate, especially real estate, as a result of the slump in that industry. So yes, it's very negative because, quite frankly, it took us a long time to create those 1 million jobs. And as far as we're concerned, the speed at which we redress these job losses that have occurred will depend on the pace of the recovery.
Yeah.
Now, if the pace of the recovery is going to be a sluggish, slow, patient little crawl out of recession, then quite frankly, you're not going to put any strain on capacity. And if you're not going to put any strain on capacity, you're probably going to see that fixed investment activity is going to lag, and therefore employment will lag behind. So we don't see those two, turning very quickly, and we're going to live with this negative situation for some time to come.
Let's take a look at the role then the South African Reserve Bank needs to play in terms of instigating some speedy pace to this recovery. I mean, we know that South Africa has exited its first recession in 17 years, but there are all these conflicting factors to consider at the same time. So do you see them cutting rates next year? I mean, what's your view on what they might do come in January?
Well, we held the view for a very long time, painfully, that we were right on the August cut, which nobody anticipated, but we held the view that there was another 50 in it for a long time, and we thought that they could cut with another 50, taking prime down to 10%. Now, that has not come through, and the reason for that is because of the recovery story. Increasingly, people were looking at the global economy, seeing that it had turned the corner. Never mind that that turn has actually been hugely artificial, and there is still, to date, no substantial evidence of any underlying private sector demand. But the recovery story sort of took the attention away from the growth side, and the greater risk was the upside risk to inflation. And that's what motivated their decisions, and you can understand it. For us, therefore, we've had to change our mind, and we've decided that they probably won't cut again, unless two things happen. Either the economy, as far as growth is concerned, relapses badly, or you see inflation gain some sudden downward momentum. And I think in those circumstances, then they probably would consider another cut. It won't be a lot, though, because inflation is going to be sticky.